we are going to look at a case study of an attorney who serves as general counsel for a Fortune 500 company. And I'll let you know that my favorite thing about this meeting and just connecting with her is, one, she's an extremely considerate, humble individual. She understands corporate law, also understands real estate law, very sharp individual, knows her stuff when it comes to money and knows what to look for. So getting a whole life insurance policy right. She had a lot of questions initially, really dug into how the policy is set up, internal rates of return, looking at it to see, okay, is this the best possible setup? I want to diversify among different insurance companies. We're going to walk through it here. Now, I did ask her how she had originally found us and became interested in high cash value life insurance. And what had originally interested her is she was exposed to the idea of the infinite banking concept. That was interesting to her, looked at different sources, but she made a comment that she wanted more. She wanted to understand the life insurance product, particularly the cash value, flexibility, different insurance companies, but then second, wants to know how that policy fits in with everything else that she has going on. Her real estate, qualified accounts, other investments, her present income level that's very high. How does she plan with these policies, not just to accumulate cash value and leave a large legacy, which will have a very large legacy, but how does it tie in to her retirement planning and also spending assets in retirement and still leaving a legacy? And that's something we go through in our retirement videos as we really help people plan with life insurance. But that is what led her to us, really what intrigued her from a cash value life insurance point of interest perspective. Let's get into it and have some fun. So, primary goal here, maximum cash value. Wants to avoid the following. Why wasn't that shown this before? How much did the agent make in commissions if I get a bad policy? This question often comes up after the fact. How do I get the right policy? Because I don't want to be taken advantage of. I do not want to have buyer's remorse. And it is my money as the consumer, not the agent's. Always very good to set that up front because it's the truth. What happens with cash value life insurance is so often people are shown one option, they're told it's the best option or a good option, and then they find out after the fact it could have been set up differently and like, oh, great, now I've wasted all that money. Why didn't so-and-so just show me this from the beginning? So, what to look for in a policy? Cash value, policy design, company selection, and flexibility. Recap from the first video. When done right, a high cash value life insurance policy is a safe, liquid, tax-free area to position money. I've got that unique loan feature when I see loans and compounding. What that means is once your dollar passes through the cash value of a life insurance policy, regardless, if I just let that dollar sit and grow and produce 3 to 5% tax-free, or if I decide to borrow against it, if I pull money out, I continue to earn that growth rate on any money in cash value and what I loaned out. No lost opportunity cost. Here's what to look for from a properly designed policy. 85 to 90% cash value in the first year with non-corporate based policies. Break-even point between years 3 and 5. And then flexible, not locked into high payments. And we're going to get into detail on that. Let's take a look here. So this will be really interesting and a lot of fun. Okay, so they had diversified among different insurance companies, and the plan that she ultimately selected was, how do I set up a policy where I can fund it with a lump sum that I presently have, and I want to continue to add high dollar amounts if things continue to work out well for me, but basically I'd like to get a lump sum into it for 5 years and then continue to pay the premium, probably a higher amount, but at least the premium on each of those policies. So, 2 companies we've got here. 2 of the 4 major mutual companies, Mass Mutual and Guardian, wanted to diversify among the top best cream of the crop companies in the industry. These are 2 of the big 4. Also wanted flexibility. If you haven't seen our flexibility videos, there are some differences between these 2 companies, which we go into full detail in those videos. So, what do we see here? Payments, $300,000 for 5 years. $300,000 for 5 years. What do we got going on here? based on the present dividend values, repositioning assets, and specifically what had happened when I say repositioning assets was money in cash, money that had just piled up saying, hey, I've got excess funds here. I want to put it at work, but I still want it accessible, Steve. So $300,000 per year, Mass Mutual policy, about $260 available right off the bat. Guardian policy, about $264 right off the bat. Annual internal rate of return in the first year. What do you notice with both of them? That's the hit. If anyone's not going to purchase a whole life insurance policy, the number one objection with well-designed policies, max cash value policies like this example, is often that first year. Money can go where? Toward the premium or the PUA component. Here we've got $300,000 going into each of the policies, $600,000 total, and the minimum premium is set at, guess what? $30,000. There is a term rider attached as well, but that is what is taking the biggest bite out of the cash value immediately, right off the bat. Now, as time passes here, we continue to make those payments. What do you notice? Mass Mutual policy, based off the present dividend rate for 2021, these are dividend values, breaking even year 5. Now, Mass Mutual for 2020 has a 6% dividend rate. Guardian for 2020 has a 5.65% dividend rate. Now, one thing I also want to mention is this came up in the conversation, and I'll often go through it with everyone, and our entire team will state this, is if you are looking at any of the 4 major mutual companies, while they have different dividend rates, the dividend rate should never be a reason why we purchase one company over another. If one thing has been consistent in all of the historical data that I've seen is those 4 companies go back and forth with each other in terms of real results. These are projections. Who has consistently delivered among the strongest cash values? We've seen those 4 major mutuals do just that. So while the projections are different, we always like to make that very transparent, share historical data. We've got several playlists available to our clients. But it's good to be aware of that. This way we don't see one illustration that looks great and then it doesn't just dominate everyone else. They always even out. But with that said, you've got the present dividend rates. Is the 6% dividend what she is earning on her policy? No. Annual IRR, internal rate of return, is the net growth after the insurance company's expenses, mortality charges, fees, loads, everything. It's the net growth annually. So first year and second with the Mass Mutual product, we see a hit. Beginning year 3, because that minimum premium begins to come back to work for us now, we start to see a positive yearly return. There we go. Front load it for 5 years, just the premium thereafter. If she wants to continue to fund it at $300,000 per year, she absolutely can. But here we just modeled $300,000 and the cash value grows quite nicely. Death benefit starts out at $7 million. The reason why is that $7 million death benefit gives her, guess what, in terms of a MEC limit? $300,000. MEC limit has a direct relationship to an individual's age and total death benefit on a policy. So there's our annual internal rate of return, tops out at about 4.65%, and then the average internal rate of return, which shows factoring in the negative years, what do I average out at? As we scroll down, it gets very close to 4%. Here's what I want to emphasize here though, is if you do everything right, we don't trigger a modified endowment contract, we don't cash the policy out once there's a gain on it, we can effectively use our cash value tax-free all the way through. Again, we've got to avoid a taxable event. So what is the taxable equivalent? Some people like to look at this. Here, we ran a taxable equivalent at 35% as far as a tax bracket. It'd actually be a bit higher than that, but we just ran it at a flat 35%. We can adjust it over time. So what this tells us here is if we look at year 10, the annual IRR, if I have a 4.51 net internal rate of return, that's the tax-free growth that particular year, what would I have to earn in a taxable account based on my tax bracket? just about 7%. Same thing if I look at the average, 2.75%, taxably equivalent, 4.23%. Then tie in the benefits of a cash value life insurance policy being safe, liquid, tax-free. The safety and liquidity, the tax benefit is here in the equivalent, but that's where that advantage all bundled together has a huge impact for individuals. And to be clear, we never want to take the stance, and this conversation came up just as I was speaking with her, to say life insurance is the best area, put all of your money here, abandon every strategy, get out of the market, we're all gonna blow up. No, because we see that among a lot of life insurance agents, and then financial advisors and people who are very heavy on the stock market say, stay away from life insurance, worst area ever to position your money, put it all in the stock market. Everything has pros and cons. When you look at the ultra wealthy, they are diversified in both areas, like this case study here. So, well diversified. There's the Mass Mutual product. Here's the Guardian product. Breaks even earlier. The company overcharges for the base premium only in the first year. So an earlier break-even point. Death benefit, however, is almost identical. Why is that as I look at the two? Because the death benefit has a direct relationship to, again, that MEC limit, 300K. That is an IRS limit. So Guardian has a lower dividend rate right now, which is why the projected internal rate of return is lower over time. But again, we expect them to even out over time. And one of the first things that came up just in the conversation with her was that she did prefer diversification. She wanted to be diversified, just more comfortable with that, likes the big companies. You can't go wrong with either one of them. Like, you can close your eyes and pick one of them out of a hat, but still, I like to diversify. Okay, let's look at options with diversification. So there are the present dividend values, but it goes much further. The next step was to look at the guarantees. I don't want to just see the present dividend environment. Show me the worst case scenario. And this is not a case if you're an agent where you can come in and say, well, that's never going to happen. Let's just go back to the non-guarantees or a conservative dividend. If someone asks for something, show it to them. Show it to them. Be transparent. Let's take a look here. So, exact same product here. Everything's identical. The difference is guaranteed values only. So, based on Mass Mutual, what do we notice? Identical outlay, break-even point, between years 7 and 8. Really, year 8 is where we're positive based on the guarantees. First 3 years, annually, we're negative. Now, what's happening here is the company is overcharging us for the base premium primarily in the first and second year. The 30K, based on the guarantees, about 0 of that shows up in cash value in the first and second year. Year 3, most of it comes back. I've got a term rider expense in here as well, which is why I still see that negative annual IRR growth. And then year 4, I pay in $300 and I get exactly that back, plus $30, not even that, $20. And then each year it gets stronger and stronger. And this is the annual internal rate of return. Looking at the average, you'll see this leave the red and get into the black when I go positive here. So when you look at the average internal rate of return, when that will be positive is when you have more money in cash value than what you paid into the product. Moving on to Guardian. Well, first let's look at the taxable equivalents. So based on the guarantee, which is a gross rate of 4%, what's your IRR top out at? Annually, just under 3%. Based on the average, gets a little above 2.1%. There we go. Still, alternative to a bank account, a very conservative asset, and from a legacy standpoint, accomplishes what she is looking for. Transitioning onto the Guardian product, their guarantees are a bit stronger, and that is not due to a higher guaranteed rate, because they're both the same. That is due to a lower internal expense ratio and the product that we selected here. Same thing, based on the guarantees. This is the kind of stuff you can see with a properly designed policy. Breaking even year 5 based on the guaranteed values, not the non-guaranteed. guarantees. You've got to use a 1-year term rider, minimum premium here. Only way really to accomplish this. You could do it with a level term rider, but it's not going to be as effective. You're going to lose a lot of flexibility down the road. Annual IRR. There we go. Tops out at what? About 2.8%, a little bit less. There's your taxably equivalent at a 35% tax bracket. Same thing over here with the averages as time passes. Effectively, just repositioning assets. And then what's the total death benefit look like over time? Guaranteed, based on the funding, just close to 6 million. I mean, I'm sorry, 12 million when you add the two together, not quite. In reality, if you look at any of the 4 major mutual companies, they've always operated in a non-guaranteed interest rate environment, meaning they've always done better than that. Even when you look at poorly designed policies, they've performed much better than the guarantees. I hope you found this valuable. Let us know if you have any questions at all, and we'll talk to you soon. Enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.